Bloomberg is now on your dashboard. With Apple CarPlay and Android Auto, it gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. It's free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple App Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by our sponsor, Interactive Brokers.
Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. Let's check in with Ed Harrison. He's the senior editor of Bloomberg News. Get his thoughts on these markets. Ed, thanks so much for joining us via Zoom here. What do you make of what we heard from Fed Chairman Powell yesterday, and then maybe the market's reaction to it?
Yeah, I think there are two things there, Matt. One is that there was no pushback from the Fed, and I think that's the most significant of the two things. The second, obviously, is the dot plot, which was relatively dovish. But when you add those two together, particularly the one with the lack of pushback, it says that markets have room to rip from here. And this is exactly the opposite of what I was thinking ahead of the meeting. I was writing that the Fed would at least do a perfunctory pushback, but that's not what we got. When you look at the transcript of what Powell, when he was asked questions, Nick Timiraos of the Wall Street Journal, he asked him, look, we've gotten a lot of easing in policy on your behalf by anticipating a funds rate next year that's a full percentage point lower in September. And Jerome Powell said in response, he said, look, we're just going to do what we have to do. We're not going to think about the market. They're going to do what they need to do. And we'll meet somewhere in the future in some place. And that was enough for the market to say, okay, look, we have no pushback here. We're definitely just going to let it go.
It's interesting, Ed, because when you think back to the November meeting, that was really when Powell had pushed back on all of the, or really paid more attention, I should say, to financial conditions. And that was a time when Treasury yields were really going higher. And, it was like, oh, well, this is maybe kind of nice. They're doing a bit of the work for us. Like, we'll take that. And now there's been so much easing just built in the Treasury market for people thinking that this pivot was coming. Of course, now that the decision has come, stocks and Treasuries just ripping further. So is there really, does Powell still care about the, financial conditions at this point, or he's kind of just willing to let them go as they please?
Yeah, I think that he's given up on looking at it. It makes a lot of sense in terms of thinking about where we are in terms of the easing cycle or the tightening cycle. We're basically, by giving up on trying to get financial conditions in order, he's moving to a full-on, data-dependent mode. That means that we're not giving you any guidance except for what you get in the SEP. And as the data come in, we're going to do what we need to do, and you guys do what you do. So in terms of going until the end of the year, we got the retail sales that you guys were just talking about, which were bullish, as well as the initial and continuing claims, and the markets just completely disregarded that. You look at the Treasury markets at a minimum, and they continue to go below 4% on the 10-year. And so what that says is that the path of least resistance until the end of the year is towards lower yields. And then we'll have to see what the data show. And when the data come out, we're going to see some volatility because there's no guidance as to what the Fed's reaction function will be. Everyone's now thinking March for the first cuts. But if we see those retail sales numbers again and again and again, like that we saw today, then people are going to have to push back those expectations.
I think one of the risks here, as I just kind of look at the market reaction yesterday and today, is that, Fed Chairman Powell may have lost the ability to rein in this market if the data does in fact go the other way. I mean, it's just, he seems to have, kind of unleashed the wild spirits, if you will, of this market. I'm not sure how he ever gets back to any kind of cautious narrative here. I'm wondering if he's, I'm going to say misplayed yesterday, but maybe it was misinterpreted by the market, or it just seems like it's tough to close the barn door now.
Yeah, I think that is a worry. My worry is, and I've said this before, is 1999. When I talked to you 2 times ago, I think we were talking about partying like it's 1999. He's allowing that to happen, and obviously, if that happens, then what you see is a harder landing down the line. It's very difficult to see a scenario in which you have unemployment at 3.7% for an extended period of time without the Fed having to continually be at the ready to tighten financial conditions. And that's where we're headed into 2024. And with markets increasing the price earnings ratios, increasing their bets on cuts of interest rates, it sets up a very nasty headache down the line potentially.
Yeah, I mean, let's just roll it back just a little bit here for some perspective. So we had that awesome jobs report on Friday of last week, great payrolls number, unemployment rate down, and wages were up. Fast forward to this week, the CPI report, obviously, a bit of concerning, I would think, for Fed officials there, that service sector inflation still very much powering ahead. So not much of a dent there. And then, of course, they didn't get to see today before they met the retail sales and jobless claims data. But you would think all of that would be supporting higher rates at this point and not be talking about cuts.
Well, I'd be interested to see what Michelle Bowman has to say, because I know that Powell, he flicked at her a little bit so as to not leave her dangling in the wind. She's one of the few people who thinks that rates should be higher. He said that we could go either way, but really it was a very perfunctory, very lip service type of comment on his part. I think that, the wind is blowing towards easing, and to the degree that we see those numbers that you were talking about, Jess, go down, then we are going to get the easing that people expect, perhaps not as quickly as they expect, but the Fed is primed in that direction, and I think that that's the path of least resistance at this point in time.
So, Ed, I mean, what's your view of inflation here? I mean, I guess the Fed feels like it's on the right path, which it arguably is, but I guess it's just a question of timing to when we get to the inflation level that the Fed really looks at. What's your view?
My view is that we're in an interesting paradigm that we haven't seen over the last 20 years, where you have the deglobalization, you also have a dearth of workers as the baby boomers leave the working population. So there are some structural changes that create upward pressure on inflation in the U.S. in particular. And so, with core PCE inflation at 3.5%, that's almost double the Fed's mandate. Really, you could get down to something in the twos, say like 2.9, and the Fed could start to ease. But beyond that, it's going to be very difficult. And so I think that there's going to be a lot of pressure on the Fed going forward to continually be at the ready to tighten financial conditions, because inflation is likely to continually be sticky given those headwinds.
20 seconds here, Ed. When's that first cut coming?
I would say the first cut is going to come June. That's what I would say.
June, okay.
And so we're going to see some steepening as a result of that, and then it's going to be a rapid cut, because by that time it'll be clear that the economy has deteriorated.
Ed, thanks so much for joining us. Really appreciate it. Ed Harrison, senior editor for Bloomberg News. We certainly recommend Ed's Everything Risk column. Good stuff, good reads all the time, and we appreciate getting a few minutes of his time.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
People certainly liked what they heard from the Fed yesterday. Let's bring in Jay Hatfield. He's a CEO, founder, and portfolio manager at Infrastructure Capital Advisors. He joins us live here in the Bloomberg Interactive Broker Studio, like he always does. Never mails it in, never phones it in. The kids could learn something from that. Jay, I don't know. What did you take yesterday? It certainly surprised, I think, the market with Fed Chairman Jay Powell's, I guess, tone of comments, maybe even the dot plots as well. What did you take away from it?
Thanks, Paul and Molly. Well, we were surprised, like the market. We had thought that the Fed was only going to have 2 cuts priced into the dot plot. So it's a welcome relief. But I think that you've had some new participants that's come onto the Fed, like Austin Goolsbee, and they're looking at what they should look at, which is more a mosaic of data instead of myopically focusing on this PCE core. We think that's a disaster and makes the Fed fundamentally flawed.
Disaster, really?
Total disaster. Yeah,
A lot of headlines.
What's wrong with core PCE?
The problem is you have to look, if you watch core PCE, then you'll end up being an incompetent Federal Reserve, and you'll call inflation transitory when it's skyrocketing. So what you should do is look at PPI, look at CPI-R, that's our index, or in other words, adjust the horrible shelter component of BLS, and then use something called judgment instead of a rule that Greenspan used to use, who was the real star of monetary policy. And so it seems like they've taken a leap and are using judgment instead of just focusing on this one measure that's massively flawed.
So which ones are, well, you just rattled off a couple of metrics there. Which one do you think right now has the most of a signal right now for inflation that you're really paying attention to?
Well, the reason that we've kind of nailed this cycle since the pandemic is that, unlike the Fed, we look at monetary policy, which drives housing market. And then we're lucky because we're energy investors. We have a pipeline fund. I founded a pipeline company. So I would argue, if you have those 2 inputs, you can ignore monetary policy. Just look at the housing sector and energy prices, and you will be a good forecaster. So right now, housing prices did come way down. They have ticked up. We talked about the last time. So that's a little bit of risk, but rents are low. So we might have to have yet another index that has just rents.
Yeah, like you said, you would not know that looking at the CPI index of shelter.
Or even our CPI-R is ticked up because Case-Shiller went up, but rents are down. Again, this is the mosaic you have to look at. So we do think that inflation is contained, and we are pleasantly surprised that the Fed seems to agree with us right now.
All right, Jay, make sure our headline writers are ready here. What have you done to your S&P 500 price target and why?
So we raised it this morning, and the best way to summarize why is a terminal command, MIPR, which I would recommend everybody boots up. We sort of sadly only figured this out about 2 weeks ago.
That's market implied policy rates for everyone tuning in.
Yeah, so if you look at one of the columns, it's a sea of red, but that's good red. So those are all the rate cuts that are priced into all the major bond markets in the world. And so it's kind of obvious this data should exist because we have it in the US, right? Because there's a futures market in every country. And so what's wildly bullish about this is that we were on 2 or 3 months ago, and we had this non-consensus call that the Euro economy was terrible.
Yep, you did.
And that the Eurozone would be forced to cut, or ECB would be forced to cut. But the good news is you don't even need to listen to our rationale because that's what market participants believe now. So I guess they're avid listeners of Bloomberg Radio. And also, if you hover over the Eurozone chart, you can put up a GPO chart, and you can see that it did plummet over the last 2 or 3 months. So this is the heart of the bull case. But it's even better because the ECB was very recalcitrant today and has what we think is kind of a crazy forecast of plus 0.8% for GDP next year, which we strongly disagree with. But the good news is we need to agree with our variant view on their economy because market participants in the Eurozone who trade Eurozone futures agree with us. That number did tick down a little bit. It was 144 is the negative, the cuts priced in next year. After Lagarde's speech, that ticked down 6 basis points. So it was a pretty hawkish speech.
All right, so let me just summarize what the good folks at your firm, Infrastructural Capital Advisors, did this morning. They raised your price target for the S&P 500 to 5,500 from 5,150. That's based on a 21.5 multiple on S&P consensus earnings for 270. So that's your 2024 year-end target?
Correct.
And for perspective, we're right now at 47.25.
Correct.
Right, so that's good.
Yeah.
What's the risk to your outlook here? Is it earnings risk? Is it macro risk? What are some of the issues you're concerned about?
What a lot of people don't appreciate is the multiple on the market is 90% driven by long-term interest rates. So the reason we upgraded it is that we had this non-consensus call that rates were going to drop from 5, but that looked a little bit problematic, so we were pretty conservative about 10-year. So, but at a 350, that implies a 21 times multiple on S&P EPS. And the consensus is 270. And by the way, we did this methodology last year and came up with our 4,500 target. So it's just a very straightforward, if you don't like, as you're pointing out, don't like one of our metrics, you can just plug in your own. We're using 3.5%, which implies 21.5 actually, and 270 on earnings. And we are bullish about earnings. And we think most people miss the dynamic that earnings normally go up by 10%. You don't need margin expansion. You don't need a very strong economy because companies are retaining earnings about 70%, invest about 15% after tax. That implies 10.5% growth. So the earnings estimates are normal, not crazy. And we don't think you need to debate that and wring your hands about it because it's the companies reinvesting their cash flow, primarily driving earnings.
So you had started off by telling us that the Fed and the dot plot yesterday indicated 3 rate cuts. You think that there's only going to be 2. The dot plot, though, there was a pretty wide range in there. You know, that's just the median with 3 cuts, but there are 8 participants who saw fewer reductions, 5 expect deeper cuts. We obviously don't know whose dot really belongs to who, but you could take a reasonably educated guess. Who do you think is really the voice that you're following the most right now?
Well, we think that the thought leader initially was really Goolsbee, that he came in and sort of said the emperor has no clothes, that the labor market is not the key driver of inflation. And I think that you got to the heart of the matter, is that Powell was probably forced to come off his tone because he had a number of participants saying that inflation is actually plummeting, that the economy is at risk. We think it's fine, but it is at risk if they keep rates. Because keep in mind, if inflation really is going down, then real rates are skyrocketing if you keep them flat. So it is encouraging that there apparently has been a little bit of a Powell's coup, and the hawks have been moved more to the center or even dovish.
Off-topic question. UC Davis is where you graduated from. I'm a huge fan of the University of California system. It's just amazing what they've done over generations, haven't they?
Yeah, so the advantage too that particularly those Northern California schools have, like UC Davis, is that if you look at a map, if you're not from California, it's extraordinarily close to Silicon Valley.
Yep.
So those are great training schools. You don't learn, like my kids, Latin and all these other things. But you learn, I was trained in business, economics, medical. So just a real professional school. It's practical. It's meant for public, kids as top 10% students. So probably the model of the future, although these are great schools we have in the Northeast.
Yeah, but it's just, Professor Galloway from NYU, I'm a big fan of his. He's a huge proponent of the UC system and what it did for him and what it does for generations of kids in California to bring them to the next level. And that's powered a lot of the economy, the great economy for California over the last 100 plus years. So Jay Hatfield, and then you got your MBA from some place in Philadelphia, I don't know. Jay Hatfield, he's the CEO, founder, and portfolio manager at Infrastructure Capital Advisors, raising the price target big time.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Again, movements in the markets here. We had a Fed that look at the market reaction, took the market by surprise with its
cheerleaders everywhere.
I don't know.
It is a good day.
Just ripping here. Neil Grossman. He doesn't strike me as a cheerleader, but Neil Grossman's here, former CIO at TKNG Capital, joins us here in our Bloomberg Interactive Broker studio. Neil, what did you make of yesterday and the reaction in the marketplace?
First off, good morning and happy holidays. I think that was Christmas.
Yep.
Couple of things, I guess. Number one, I think what I took away, number one, is under the hood, Mr. Powell may have just told everybody he's changing the definition of what inflation measures they're looking for, raising the target. Because I was amazed. The thing that really was most amazing to me was the fact that he said, we can't wait till we get to 2% to start removing or providing more liquidity, because that would be too restrictive.
So is that a different message than?
Well, that means 2% is no longer really your target. And not only that, I know we've talked about the fact that we're now going to have close to 4 years or so of high inflation on an average basis. But I think what's happened is he's raised the probability that getting to 2% is dropping, and the potential for reacceleration is a problem. I mean, look, this whole rally started, I guess 5-6 weeks ago, when he made the comment that the market's doing the work for them. 10-year notes were about 5%, give or take. Yeah. And interest rates have dropped a full 100 basis points, basically.
Yep.
The stock market's up something like 20%. As of yesterday, the dollar had been weakening. You had a drop in commodity prices. So everything was, since then, has functionally said we're providing a lot more liquidity to the market. Unemployment, or the employment structure, has although, yes, it's weakened. This is a very interesting thing in a minute. It's still remarkably strong. So here's an interesting question. After the last employment number, the 12-month trailing average of job creation was still at 235,000 jobs.
That's pretty high.
When was the last time that happened?
I'm going to say pre-COVID.
2015 for a short period,
Okay.
and before that 2000. So to add 235,000 jobs a month is an extraordinary rate of job creation in the absence of the fact that it's coming down from what were much, much higher levels. So the relative strength of the economy, because if you look at a 500,000 a year before, there's a slowing there. But our job creation rate is still extraordinary at a time when more or less maintaining the status quo of unemployment is give or take about 100,000 a month.
Let's just come back for a second to one thing that you had just said. So, and correct me if I'm wrong here, but I don't think the expectation was ever that the Fed was going to wait for inflation to get to 2% before they started cutting.
I don't think that they'd ever made any comment. They had a 2% target.
And they still do, as far as I know.
I don't believe that.
Why not?
Because I don't think they're going to get to 2%. And even if they do get close to it, the type of liquidity provisions that will already be in the pipeline are going to be raising the probability that they're not getting there. That's why, right? So if the Fed's now talking about 3 cuts next year, the market's got, I don't know, was it 6 or 7 over the next? If you're liquefying through the equity market, if you're liquefying through rate cuts, you're already lowering, number one, the price, or raising the probability that prices are not going to fall as fast. Number two, which is sort of he didn't want to talk about yesterday, I guess, we've had a lot of wage settlements in the private sector, but also in the the COLA adjustments for retirees. By the way, I'm one now, so I'm going to be getting a lot more.
Congratulations.
But there was an 8.7% increase this year.
Big.
Every government employee, I believe, and many public, quasi-public people are also inflation adjusted. So those types of wage increases with inflation falling means there's a lot more potential upward pressure that can be consumption driven through a large part of the economy.
Yeah, and but you're not seeing, like, in general, though, like inflation-adjusted earnings as a whole, ripping that much higher. I mean, it's now been positive for, the last 6 months, but we're negative for 2 years.
Well, I'm not sure how negative they were. I guess, first of all, you had what might be negative in a direct payment, but you have to add in the type of money the government was giving to people in the alternative, and also, for example, which is on the other side now, but telling people they don't have to pay their mortgages. There was a lot of
student loans,
structural issues that made relative income look far better, maybe than the straight measure of the payments themselves. And I think what you're going to find, I mean, we'll see, but I think it's going to be very hard for any business that's got unionized employees and the government itself, when it comes time to renegotiate, to sit there when their employees say that's what they got, we get the same thing, which means there's an enormous amount of risk that in fact we have much more wage inflation in the pipeline, or wage risk in the pipeline, than anyone wants to accept.
Not a whole lot of unions left, though, really, to drive that forward.
Well, there are 20 million government employees in this country.
They have a good bargaining power?
They still have pretty good. I've never seen a government employee fired. I've never seen them be asked to take a wage cut,
so,
et cetera.
Do you think, in hindsight now, just seeing what the markets have done yesterday afternoon, this morning, I think Fed Chairman Jay Powell says, ooh, that's not necessarily the message I wanted to give.
I think he knew exactly what he was doing. I mean, he had an opportunity to couch this slightly differently. As I said, I think to me, the single most important comment was the fact that if we're waiting till we get to 2%, we've waited too long. We see prices coming down. He didn't use the same statement he'd made 6 weeks ago. He should have said the market is now providing the type of liquidity we need. We don't need to do as much because of this, but he didn't do it. So I think embedded in this message for the moment is the risk that they've now accepted a higher level of inflation as part and parcel of their policy, which I, of course, think is a terrible outcome. But
a lot of people have been calling for that, though. Saying look, we've got a structurally different economy that maybe so an inflation target more around 2.5% to 3% is more reasonable for the world that we're living in now.
Well,
does that not sound legit to you?
No.
Why not?
Because it has none of us have the privilege, from my perspective. Who set the Fed's mandate?
Congress.
What is the Fed's mandate?
To maintain price stability and maximum employment.
Right. And what is price stability? Zero inflation. So
is it?
It is. By definition. Now, the fact is the Fed was an unusual institution because it had a dual mandate, and there's a lurking third one about stable long-term bonds. But the bottom line is they have a two-factor optimization, which allowed them to functionally play with both. I think it was the Swedish central bank who motivated this move to 2%, but 2% is still not their theoretical mandate. And in fact, what was really sort of sad to me, they had inflation at about 1.25 to 1.5 and full employment about a decade and a half ago. And they said, well, that's no good. We don't like inflation below a level. And then all the modifications in how we define inflation and all these other measures. The answer is if it's not a good thing, the Fed should be going to Congress. And by the way, just to get off track, Lena Khan and the FTC to me are the same issue. She is a regulator and an administrator. She's not a legislator. She is trying to functionally change the definitions and the practices in the antitrust world. She should have gone to Congress. She's lost every case, basically, and it's costing American businesses hundreds of millions, if not tens of billions of dollars in business and legal costs. It shouldn't be for that. She should be in front of Congress saying, times have changed, things have changed. Please, we need to revisit this. And so my point to your question is, all of us, we can all decide what we want, but we live in, theoretically, and I think the Fed is telling you that doesn't make a difference, we live in a system where authority is granted from Congress to agencies to apply what they said, not to simply say, I don't really care what Congress said.
Right.
We'll do what we want.
All right. Neil, great stuff. Well, you could do this all day, right?
Oh, man. I feel like Neil and I could probably talk for the next 3 hours on this show, but we're going to have to keep it there for today. Thank you for joining us.
All right. Neil Grossman, he's a co-founder, former CIO of TKNG Capital.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We want to get right to our next guest because we want to talk commercial real estate because I've got some big-time opinions. I know nothing about commercial real estate. I know nothing about it, but I have some opinions. Our next guest really does know stuff about that. Miki Naftali joins us, CEO and chairman of Naftali Group. Miki, thanks so much for joining us here in our studio. I'm a huge fan of New York City. I'm a huge fan of New York City real estate. But man, I'm hearing some dire stuff. People aren't coming back to the office. I'm looking down 3rd Avenue. I see lots of empty space there. What's your call on just, I don't know how you want to go with this, New York or just big cities or how you're thinking about it?
Thank you for having me. So first of all, I don't believe in the office sector of real estate. So I invest mainly in the residential sector.
Okay, well, people got to live.
Yeah,
Yep.
Exactly.
Okay.
So this is the thing. We really follow the demand.
So do you just go to Florida then?
Well, no, but let's talk about New York. So, in the past, I actually converted many office buildings to residential. And then there was the period of time of, great office buildings and even office buildings in in neighborhoods such as at Chelsea and the Flatiron that were taken by the high-tech kind of companies and converting back to office. But my view of the office space is not great. And unless you have a truly Class A brand new office space.
Like this one?
Like this one, for example.
That you're sitting
right,
in.
with all the amenities that you have
Yes.
here, which is great. You're not doing well. The residential is a completely different story.
Let's talk about that residential. Right. So New York City, we were talking earlier, right. We both agree that it's not dead. But in 2020, there were a lot of people, including myself, where it felt, I was sharing with you, I loved how quiet it was. But you did what a lot of people said couldn't be done, which you essentially sold out a beautiful residential building on 79th and Madison, smack in 2020 into 2021. How did you do that? And talk to us about how you were, what was behind that process.
So going back to 2020, once COVID hit us at around March, we started to hear on a daily basis, New York City is dead, New York City is dead.
Now, did you have butterflies in your stomach around that time just for a little bit, or were you?
Well, I was already in, and I had this I had few projects. One of them was 3 years in the making. I bought multiple walk-up buildings on Madison Avenue, and I designed and I started to build the first high-end residential building anywhere between Park and Fifth Avenue in 25 years.
That's
right?
Incredible.
So think about it. For 25 years, the only option for anyone that wanted to live between Park and Fifth Avenue, and I would say high 60s to mid 80s, is either one of the co-op buildings. Some of them are very famous, but old, small windows, old elevators, old mechanical systems, and no amenities, right? So for 25 years, no one could really figure out how to build a new building. So anyway, we were already coming out with the superstructure on Madison Avenue between 79 and 80. And I was planning to open the sales office originally in April of 2020. Obviously, I said, oops, let's stop, right? Let's see what is going on.
Whoops. Couple butterflies.
Exactly. But then when the superstructure, we kind of stopped for about 2 weeks, construction in New York, and then we continue, and we coming up with the ground, and the superstructure was almost stopping off, and we started to get phone calls from brokers and direct from buyers calling our office. Now, we didn't have any sign on the site except our name, our company name. So people Google whatever, and they found our phone number, and they called us. So I said, oh, very interesting. So there is a demand. People are really, they're really curious. They want to buy. So September of 2020, I decided to open the sales office. The space was ready to open. I didn't open it, right? September 2020, I opened the sales office. And between September and December of 2020, I sold out.
That's amazing. That's just incredible, because having been here, the city really was.
The demand is here in good days and bad days. Of course, there is a slowdown. Of course, but at the end of the day, if you have, by the way, not only real estate, if you have a product that is there is a real demand for it, you're going to do well. It's all about inventory and demand, right? So there was zero inventory and there was a demand, right? So that's why we were, that was the first of 3 projects that since then sold out. Sold out on the Upper East Side. All of them were doing extremely well.
And they're, I'm now here in Sutton Place, but I had been on Upper East Side, and I saw day by day the one on 83rd go up. Just absolutely very distinct. And I think it's at the limestone, but the amenities, it's really pretty incredible.
So I want to ask you, selfishly, I just put in a down payment for very exciting. I just put in a down payment for an apartment on 67th and 3rd, so in Lenox Hill.
Congratulations.
Thank you. But of course, I want to hear, if you think the value of it's going to go up. But it's, it's a bill. But you've been talking about these luxury buildings, all of the amenities. Is there still value though for some of these buildings that are a bit simpler? Maybe just like good location, doorman, elevator, laundry in unit, amazing, and a terrace. But like maybe you don't have the big gym and all these other amazing common spaces.
So I would say I don't know if the value will go up, because think about where we are in all luxury product. The way we live today, most of us, right, compared to our parents or definitely our grandparents, different quality, right? The huge different, right? So there is a demand for quality. Also, most of us are much busier than our parents and definitely grandparents.
Oh, yeah.
So we are looking for every moment that we have. We're looking for the lifestyle that everything will be very accessible and close to us. Amenities are very important. It's part of the lifestyle that we all, or not all, most of us that can afford are looking for. So I would tell you that there is no question in my mind that the appreciation of value is much higher for a really, really good product and not as much for let's call it an older product. Having said that, location is as always very important. So if you're in the right location and you have the right bones and you upgrade your unit, you will do well.
I like to hear that.
How would you describe South Florida right now? Because we had the story here, as you well know. Seems like everybody in New York City left for Miami, South Florida in general. Give us your extent. Is it too much, too fast down there, or can this market really, I guess, thrive?
So it's actually very interesting. I have two what I call mega projects in South Florida. I'm building a 70-story, 1.5 million square feet in Miami, in downtown Miami, in a neighborhood in Miami World Center, which is a new neighborhood in downtown Miami. And I'm building a very similar size twin 50-story towers in Fort Lauderdale in Flagler Village. So
bullish, I'm guessing.
Miami and Fort Lauderdale are different, but here is the thing. For us, okay, it's all about demand. We think that we are quite good in designing and creating a really good product, but we're not good enough to create a demand. So we really follow the demand. We look at where the demand is, and that's where we go. Specifically about Miami. Miami matured to a point, in my opinion, of no return. Yep. Miami can offer not everything that you can get in New York City, but almost everything between culture and restaurants and you name it, and sports and everything is there. And of course, many months of the year, beautiful weather and the beaches and all of that, right? So this is for us. This is a really important market. And also a market that attracts quite a lot of Latin American buyers that either want to park money in the U.S. or they as investment, or they just use their apartments X amount of weeks, a year. So I think it's a strong market. I just opened a sales office for the Miami project 4 weeks ago. Okay. We are doing well, so we think it's a strong market.
Yeah.
And that there's still more upside to it?
Yes, because here's the thing. Remember, we are still in an environment, or we are in an environment of high mortgage rates, right? So
just dropped below 7% today, but yeah, keep going.
Correct.
Yes.
No, correct. Yeah. So going forward, thinking about going 24, 25, we believe, and I'm sure that you believe, that mortgage rate will start to go down. There are still buyers that sitting on the fence and waiting, right? Yeah. And waiting. Now, long-term projects that are going to be complete in 3-4 years, anyway, they don't need to commit to take mortgages right now. So it's all about deposit and taking a position in a market that eventually there will be appreciation in price.
On this topic, just yesterday, the Fed indicated that they are going to be lowering rates next year. So it supports everything that you're talking about in terms of being below 7%, the idea that rates will go lower. Is there a point where the housing market could overheat too much? Because I grew up in upstate, and my family member yesterday was just sharing a picture of I think a 1,500 square foot house going for $1.1 million. That same house 5, 10, 20 years ago literally would have been $150,000.
Right.
And so I'm just thinking, if more fires put onto the market, it may be good, it will be good for somebody like you for a while, but at some point, is that going to create issues?
So It's
and
all
overheating?
about supply. It's all about inventory, right? And in the main, in the main cities, there is by and large there is lack of supply.
Right.
Now think about it. It's not only the mortgage rates. There are only few developers that can build today. We were either lucky enough or qualified enough to close.
No, it's just running out of time. We'll get you back next time in New York. Sounds like you're in New York a lot, so we'll get you back. Or we'll go down to South Florida. Miki Naftali, CEO and Chairman of the Naftali Group. We're going to have more coming up. This is Bloomberg.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.